All right. Hello, everyone, and welcome to another Facebook Live session. I am really excited today. We are going to dive into this forbearance crisis, what's going on, and the housing outlook. And I'm going to make it so you can see everyone that is on this call, because we have a lot of really wonderful people on the call, a lot of people that you've seen here before. Our special guests that we have here today, we have Ivy Zelman, the most influential woman on Wall Street, she's been called. She is the CEO of Zelman and Associates, a leading housing research firm. And really, you've seen her on CNBC, you've seen her all over. She's really known to be a thought leader in the housing industry. And then our other special guest star of the day is David Stevens. And he has been named one of Bloomberg's 50 most powerful people in real estate. He's been seen on CNBC, PBS, Bloomberg, and he is the CEO of Mountain Lake Consulting. And then you'll see we have Andrew Berman with us. Everyone say hello, hello. And we have the one and only Barry Habib. And I can't see everyone that's on the screen. I want to make sure that we're good to go here.
We are. We've got
Ryan Hill with us.
And Frank Garay.
Frank Garay, yes. Welcome, everybody.
Hello.
And Barry, if you want to kick it off, I'll be managing some questions here.
Yeah, I think that this is going to be a really important and informative time for everybody. And so thanks for all of you that are joining and everybody that's listening. So I've got to tell you, before we started, this whole group here has been really trying to do what they can and do our part to get good quality information out, but also to do things to be influential to the powers that be. And we're going to talk about that because right now we're facing a crisis in our industry, and we just want to make sure that everybody's aware of it. And that crisis is the forbearance issue. And there's nobody better than David Stevens to talk about that with us today. I've got to tell you that David has been just an incredible, first of all, great friend, but tireless, and I call David quite often to try to make sure that we have the most recent and up-to-date information, and David it has been nothing but incredibly gracious and helpful, and just it all has a gigantic heart. And speaking of gigantic heart, Ivy and I, we definitely speak several times a day, and as busy as Ivy is, she is so willing to be there for us so we can get the best information to all of you listening. So I am absolutely, first of all, grateful for this entire group who does nothing but try and help our industry. And for those people that are just giving their time on the call, Megan. And you're muted, Meg. There you go.
Sorry. Sorry, I'm trying to manage all these things. Yeah. I'm excited to get started here, you guys.
There you go.
So everything's popping over there.
Yeah. So why don't we kind of get started a little bit here with you, David, because I think we want to try and accomplish on this call is let's talk about some of the challenges that we're facing here and some of the issues that maybe not everyone is aware of, but that we can frame and explain, and maybe some of the things we could talk and share about, David, that you and I intend to do. And then I'd like to ask Ivy, because I know, Ivy, you just gave your forecast for how you think the coronavirus might impact housing, and that's something that we all need to understand, help our realtors understand, help our clients understand what this means and what they can expect. And maybe we can all talk about, are there opportunities or things we could be doing today so that we can kind of have a calm outlook, understand what the crisis that we're going through is, what it looks like after the crisis, and what we can do today to make that future brighter. So David, do you want to start with maybe let's talk a little bit about this forbearance issue and your latest views and thoughts on it?
Yeah, so first of all, good to be here with all of you. I sent a quote today by a guy from the Wall Street Journal who said, it's from Lenin. He said, Lenin said there are decades when nothing happens and there are weeks when decades happen. And that's the period we're in. I mean, Barry, you and I have been talking a lot lately. All of this happened unlike any other recession any of us have ever been through in our lives, because it was thrust upon us all in a matter of weeks. literally 3 weeks ago, I was on a plane from LA after visiting my daughter. So, the time frame in which this all become encapsulated has been outrageous. And the actions by the Fed, by this administration, and by Congress to shore up one part of the economy, as you know, have really caused other shoes to drop that are adversely impacting the housing economy. We had all the liquidity crisis as a result of the Fed moves. And I think, knock on wood, we're going to squeak through that period. But let's move to forbearance, because that's live. It's April 2nd. People have to make their mortgage payments. And what's different about the forbearance plan now versus when I was in the administration in 2009 is that you don't have to prove hardship. There's no requirement to provide a hardship letter. So literally anybody in a Freddie, Fannie, or Ginnie product, all they have to do is attest that because of the COVID epidemic that they're unable to make their mortgage payment. And the servicer has to provide them a forbearance plan for PI and TI for upwards of 180 days round one, and subject to servicer approval can extend for another 180 days. For the borrower, there are, theoretically you have no payments to be made, and according to directives, at least the formal one that came out from HUD so far is you have to report the credit as being paid on time. And the only restriction to that is if you are late for March, everything's off the table. But if you were current through March and you opt for forbearance beginning with your April mortgage payment, you get it. And, I think it's critical to be able to have a tool like this to be able to be offered to Americans who are truly in distress. Mark Calabria has said in an interview just over the last 24 hours that he hopes homeowners are quote unquote responsible about this and that they only use it if they really need to. It's a hard thing when the horse gets out of the barn and you don't think about unintended consequences when you announce things like this. In fact, the forbearance plan was announced a week ago Sunday. And both Mnuchin talked about it, Calabria talked about it, was reported widely in the news, and we didn't even have the details. And obviously for all of us, we know what it means, right? It means that for servicers, it could be an outrageous hit. It's been sized by one economist. That's going to be an article in The Hill this weekend. But if you put it in perspective, if a quarter of all families, all homeowners, opt in for forbearance, the first 180 days will cost about $70 billion. If they extend for another 180, it's $140 billion. The entire servicing industry last year made $10 billion. You can't put systems in place to resolve and respond to a virus that's going to destroy the housing market. And that's what really we're at the precipice of. So while there's been concerns about liquidity, there was concerns about excess MBS in the market, which obviously got an overreaction by the Fed, but they have figured that out over the last several days and balanced that out. Ginnie came in and talked about their liquidity facility and expanding that to some of their issuers so that you don't have to be technically in default to be able to have Ginnie send advances to the servicer on your behalf. That will help with liquidity. But the big stick in the shed that hasn't been pulled out yet is what was enabled by the congressional legislation is to establish a liquidity facility at the Federal Reserve. And the reason why that hasn't been set up yet is the legislation that was passed that creates funds for this purpose has to be, that checkbook is held by the Treasury Department. So Mnuchin has to write the check to the Fed so that they can create a facility that would allow banks and non-bank servicers to get advances in return for pledging the servicing to the Fed, to whatever Fed facility, whether it's TALF or something else, and that could ease up the liquidity. But we are truly in a very difficult, precarious state right now. And I'll tell you, the unfortunate reality is, it's a conservative administration that has a view that federal intervention in this space should be limited. And so all pressure has to come to bear on the Treasury Department and FHFA and members of Congress to put pressure on them, particularly Republican members of Congress, to put pressure on the White House to have them realize that they're about to cause what could be a pretty strong contraction in our space that could forever impair whatever anybody's willing to pay for servicing going forward. So it's a very tough scenario.
So David, thank you. It's obviously we've been talking about this a lot. This is very sobering, and yeah, we were able to, this group in no small part, and we collectively have been able to influence the Fed, and I believe that the Fed gets it.
Yeah.
However, what I'm fearful of is that that this message was completely botched, and I will tell you that anecdotally, what I have heard from people who are, even people that are very wealthy, oh yeah, we don't have to pay our mortgage now. And people don't understand, well, first of all, they might have a difficult time spelling forbearance, but even what's really bad about it is they don't understand that forbearance is not forgiveness. This is not a freebie. You have to make those payments. And what I'm trying to get the message out, and hopefully people are listening can get this message out, is there is zero financial benefit to forbearance for you. You still owe the money. Now, how do you pay that back? It could either be in a lump sum, it could be spread over a period of time after forbearance, it could be a modification, or it could be added to the balance that has to be repaid at time of sale of home or refinance, whenever that loan gets paid off. But the real big issue is, if you just take a look, just the math, what you're doing is, okay, you're delaying, you're keeping in your checkbook money that you have to send. You're just delaying that payment out of your checkbook, that what you might make in interest, I don't know, $20 in interest maybe to benefit your checkbook. And we're going to get Ivy to talk about this, is that when you look at the amount of transactions, somewhere between 55 and 60% of the transactions that are done by the independent mortgage banking sector, and we'll go through the mechanics of why this is so potentially, impairing to the mechanics which cause our housing system to function, you could wind up doing so much detriment to the housing market that to save $20, if you abuse this, you could cost yourself $100,000 in equity in your home. And that's what people don't understand. The government has botched this. The media has botched this. The message is it's a free lunch. The message is you're forgiven for payments. And the message is, according to Mark Calabria, yeah, we're on the honor system. A cavalier remark, yeah, we're on the honor system. I mean, this should only be for those, to help those in need that can't make their payments. So, so David, let's kind of take just a minute up through the mechanics, and then let's go through the even deadlier part of what first payment default means for this.
Yeah. So, and by the way, to your point, Barry, a lot of these loans, first-time home buyers broadly have been using the Ginnie Mae programs, FHA primarily, but we have a lot of veterans. Growth in VA was pretty strong over the last year. If you bought a home with 0 down or 3% down, you're going to be negative unless there's been a lot of house price appreciation since you bought that property pretty quickly if you forbear. So to your point, you're going to create an immobility impact. The nation is going to create an immobility impact on a lot of homeowners simply by putting this free put out there where you don't have to make your payment. But technically, the guidelines for FHA were just published late yesterday, and so you can see that online. And they're very clear and lays out exactly how the forbearance plan works. In fact, if you're a reader of Rob Chrisman, I think he has it in a link in his thing this morning as well. But the borrower notifies the servicer, and FHA and HUD have been very specific in their communication to servicers how they are obligated to respond, and that's to for them immediately not to have to make the principal, interest, taxes, and insurance payment, the PITI, and not to report that as a negative to the credit bureau. Now, I will tell you, I've seen already a response. One large correspondent buyer of mortgages in this country already put out a bulletin and their policy out released this morning that they won't allow any new mortgage on a loan that's in forbearance. Barry, you and I talked about this. I'm surprised that the credit bureaus, this will never count, but ultimately downstream, will future originators of mortgages have a different view about a loan that was in forbearance versus one that wasn't? And the fact that there's one large company put this pronouncement out today tells me that there's going to be there's known credit risk, and when someone goes into forbearance, it's because they're impaired, and that is clearly an indicator of potentially future performance, and many are going to want to find a way to value that in future credit availability, regardless what the policy says. It may not show as a mark as a 30-day late on your credit report, but the fact that you were in forbearance, if it has to be disclosed or will be disclosed in some other format downstream, I just worry about a lot of Americans thinking this is like a freebie, and that's one of the concerns I have. And as you said, we need this for to stabilize the economy for people who truly have lost their jobs, don't have the ability to make a house payment, and we need to try to do everything we can to keep them in their homes. I've been there. I was in the Obama administration in 2009 doing the exact same thing. But this is a very different thing when you don't have to prove hardship. And the fact that they removed the requirement to prove hardship, I worry is going to have a lot of reactions that we're going to see downstream that will make us realize, man, we should have thought that through. And that's one of the challenges.
And David, I want to talk about what can be done as a solution. But before we get there, let's just continue to frame this so people understand how dire this is. While that is in itself obviously a huge issue, there's something even more acute and bearing down on us, which is the issue of a first payment default. So right. If that loan does not make its first payment and the borrower says, well, I got forbearance, I got like I'm buying furniture, first 6 months, no payments, right? So if we see that occur, then that renders the loan ineligible for sale, which means that the only alternative that I could see is that it has to sit on your warehouse line, which means that it ties up and clogs it. And for those of you watching, just think about this mechanically for a minute. Let's just say you have a warehouse line of $1 million. And just to go through this here, you close a transaction with the borrower. So the borrower's just closed, the signature's there, and you sent a check, but you don't have a package back yet that's in the place where you could sell it. So it might take 10 days or so to get that. That interim period, you've laid out the money through a line of credit called a warehouse line. It sits on your warehouse line. And then within a couple of weeks, you now have a package that you can sell, get money from, and you're in good shape to reuse that money again. So if you have $1 million warehouse line, you could probably close $2 million in loans for the month. But if you start to clog that warehouse line with loans that can't get off there, David, doesn't that make it so it's very difficult for you to continue to do any kind of meaningful business just at the time when we need it the most?
Yeah. So first of all, I'm not sure we're absolutely clear on whether that can be sold or not. We're still waiting for the GSEs to say. And I spoke to a senior executive at one of the GSEs, and the way forbearance has worked in the past is it was considered you were in default when you went into forbearance, although it was permissible and you would not be foreclosed on, but it would show as a late. And so the question is, after you close a loan, it's in your pipeline, and you haven't yet sold it to the GSEs or into an MBS, is it eligible for sale? The way the past has worked is that's considered a loan in default and therefore not eligible for sale to a GSE. I'll just to make matters worse, if you can't sell it, then it's not a GSE loan, nor is it a Ginnie Mae loan, so is it even eligible for forbearance in the first place? And there are lawyers in D.C. who have been discussing this over the last couple of days. It's fairly draconian, but think about it. You originated a loan that you intended to sell to Freddie Fannie. They opt for first payment forbearance. It's no longer eligible for sale. Perhaps we need to get better direction from FIFA or the GSEs on this. But let's assume it's not. It's no longer then is it government guaranteed. Therefore, it's not eligible for forbearance. And you put the borrower, what happens then? So it is an unbelievable scenario. Now, even the lawyers that were on a call yesterday on this subject, we all acknowledge that's a pretty harsh thing to do to someone who's in trouble. But it's just the reality of where we're at. This is one of these scenarios where announcements were made about a plan, specifics were not there, and the administration didn't do what we did. And it's never perfect, but we're back in 2008 and in 2009, we called all the servicers into Washington, had them in the big room in the Treasury Department, and for 2 days, and worked through all the details, then came up with a policy, then made the announcement. A little different than what we're doing here.
David, let me ask something. Sorry, Abby.
No, I was just going to ask Dave on Ginnies, is the same issue with respect to, are they saleable if they are an early payment default? Can they?
I believe they're insurable. Remember, with Ginny, it's just an insurance company, and I believe they are insurable because if you read the FHA policy that came out yesterday afternoon, it says as long as they were current as of March, that they can go into forbearance in April and be eligible without any impairment to their credit. So my sense is that means that that's an eligible loan for a Ginny pool. It wasn't quite precise because it's an FHA policy, not a Ginny policy. So now we got to get the guys at Ginny to either tell us that's correct or not. So that's TBD.
I have a mechanical question for you, David, that has been something I'm thinking about here. So you close a loan today on April 1st. That means your first pay, or April 2nd, sorry, your first payment's due on June 1st. So you get it off your warehouse line, and in essence, you've sold that loan. So when June 1st comes and the customer claims forbearance, what does that mean? That you are then required to buy it back? How does the mechanics work on that?
Well, I don't think it does, at least under the FHA program, it doesn't, the HUD programs, because that's part of the plan. That's part of what they say very clearly in their document, which is the borrower will be considered to be performing. And so therefore you haven't violated your first payment default, repurchase requirements, or any of that you may have, because it's not considered a first payment default according to the FHA program. Now we need to see what the GSEs do. I'm assuming they're probably going to follow pretty closely what HUD did, but I don't know for certain. SIFMA, and this is something for all of us, but SIFMA and SFIG and who have also been thinking about this, and particularly SIFMA, are wondering, is this eligible for TBA? And will they allow that to be acceptable collateral to be pulled?
Just tell everybody what TBA is, David.
It's just a standard agency mortgage-backed security. Let's just call it that for now. So after you close the loan, that's going to get pooled into a security with all these other mortgages. You're not allowed to put a non-performing loan into a new security, right? That's a scratching down or goes into another kind of execution. TBA is reserved for performing loans, freshly originated in the new pools. And so if you have a loan that went to first payment default or forbearance, even if the GSEs permit it, and allow it as a sale, will SIFMA and will the bond buyers consider that also eligible? And I think a lot of this is everybody scratching their heads going, how big is this going to be? As I used those numbers a little while ago, we don't know if it's going to be 5%, 10%, or in my example, if you use a quarter of all mortgages, it's an outrageous sum of mortgages.
So before we go to Ivy and talk about how this affects the housing market, and I want to get everything from the team here. We're just trying to frame this issue because it's so critical and important. But so let's start to think about a solution for this. So while I know that there's a lot of tripwires here every step of the way, is it possible that the government could turn around hopefully with everybody that's watching this and our outreach, and David, you and I are going to put together a letter. I know Dan's going to help us with this too. We're going to put together a letter that we want everybody to get out there. Is it possible that the government could reconsider its guideline for no proof required of hardship, or is the horse out of the barn? Can they change this midstream and say, hold on a second, let's admit it, we made a mistake. We need to provide some sort of proof. And we've already had 10 million people file for initial unemployment benefits in the last 8 days. What are we going to be able to do to correct this? Or is the horse out of the barn and this is now taking on a life of its own?
Yeah, I mean, I think what we're all going to realize, unfortunately, downstream is in an effort to calm America, the Treasury Secretary and others went way over the tips of their skis and said you could go into forbearance with merely an attestation. And this is when, this is a moral crisis, I think, when you create policy this way. And we went through these discussions every time we made policy back in that previous recession, worried about things like this. And the question is, can you change it? Yeah, I mean, you could change it. I think it would be an outrageous, adverse response, but, HUD has already published their policy, so at least something is in place for right now. they could modify that policy and require some form of hardship evidence. But it would really be tantamount to the whole administration going back on its word. And frankly, I think we need to read the legislation that was passed, because they addressed this in the legislation. And I think even there, it doesn't, I think it's pretty clear it requires only an attestation, but we need to go back and look at that. My solution on how to fix this, and the NBA solution, and everybody else who's working on this right now, is do what the legislation offers. There's $400+ billion to set up a liquidity facility. I'm hearing from folks at the Fed that they're asking Treasury to fund that. And the Treasury has a platform. They already have the TALF shelf, which can provide liquidity to securitized MSRs. I'm not going to fall down that rabbit hole, but there's something they're used to doing this. They have a Fed window. They're used to providing advances. This is what they do. Use the monies that were created, provide the advances that are needed, and allow non-bank and banks to come to a liquidity facility established by the Fed for specifically this purpose. So it'd be a special purpose facility with an end date, and allow them to come and exchange or pledge their servicing rights in exchange for the draws, and go from there. I mean, this is absurd, frankly, in my view, that the government's reaction to a global crisis, a pandemic of this sort, throughout these stopgap measures, but is potentially going to drag the entire financial services industry down into the gutter as a result of the unintended consequences that were created by these policies to protect Americans. My view is, let's protect Americans, take advantage of the program, don't go back on your word. But for God's sake, use the money that was allocated by Congress and set up the liquidity facility. And the amount of monies that are in that bill are far substantial enough to be able to provide these advances. And we should not be screwing around with this, because for what all of us know on this call is, who the hell is ever going to buy a servicing right after this if they don't do this right? Even now, look what, I talked to one huge non-bank originator day before yesterday. We all know him. I'm not going to quote him by name, but huge company. And as of April 1, he's retaining all servicing. And he's retaining it at 1 to 2. That's it. As opposed to 4 to 6. That's what we were getting before in multiples. And so he thinks it's worth taking the risk, and he has a liquid parent who likes the idea because he thinks he's buying it at a discount. I hope that's true. But we shouldn't be gambling here on the future of the damn housing sector, which is 40 basis points of the GDP. I mean, give me a break.
So I'm glad you mentioned the housing sector, because that's really where I want to go. So first of all, David, not too many people that could help us understand this as well as you can. So, I think we all are indebted to you for being a great leader here and helping us understand this, man. But yeah, we're going to put something together, and we need everybody watching this to get behind this, because whatever resources we can pull together, not only do we need this done, but we need this done expeditiously. So every single one of you get your cape, and you're going to be Superman and Superwoman, and we're going to do this. And Ivy, I want to ask you to come on in, please, and chime in, because you do so much incredible work on the housing industry, and everybody else that's on this call has such a great finger on the pulse. Ryan and Frank and Andrew, they understand this well. So I want to get their take, but can you please frame for us what you see happening? Because Ivy, you and I have talked about this. This is going to be a different world. People aren't going to be hired back as quickly. You couldn't pay me enough to go on a cruise. I'm not going to sit in the middle seat. I can tell you personally, I don't think Rock of Ages, my show on Broadway, is going to survive. And that's just the way the chips fall, right? But I think that we're going to be looking at a different world, and I don't think jobs are going to come back as quickly. And we know that has an impact on housing. Could you please tell us what you see?
Well, I think if you think about a world where behavior is going to change, I think there's going to be a lot of people that actually want to be in their own homes. And I think that what has happened prior to COVID-19 and the pandemic and the chaos has been that housing was extremely strong. In fact, robust, really starting in the second half of 19, accelerating into the early parts of 2020, and business finally was in what I would say a time frame where you'd actually expect with the economy as booming as it was. So everything is sort of now at that point where we'd like to put a stake in the ground and assume that by the end of April, if it's possible to be optimistic, if that's, too optimistic, you hear the virus will peak and at some point, and experts are saying by the third week of April. If we want to be optimistic, and we assume that a lot of what you guys are talking about, and Dave, what you describe is so incredibly grim, and the recognition, anyone on the front line that really is looking at home sales, whether we're talking new construction or resale, doesn't really understand the plumbing and the mechanics of what goes on with servicers and advancing as a borrower defaults or goes into forbearance, all these things that are so helpful that you're explaining. But what we have seen with respect to the last 3 weeks is that consumers still want to buy. So as housing has been viewed as essential, we have real estate brokers and home builders that are still selling homes, believe it or not, but predominantly by appointment. And we put a stake on the ground and said, okay, let's assume that everything starts up again in May. And that's really maybe a poor assumption, but that's the assumption we had to make. And then we assume that we are in recession, that unemployment is going to continue to rise despite people going back to work in May. And if we just think about the worst case being 2Q, then we think that in 3 and 4Q, we'll start climbing out of this very deep, dark hole that we're in. But I think that what's been surprising, even though traffic has come to almost a virtual halt, as open houses have actually been now closed down, builders are selling only by appointment where they can. You've continued to see people that are coming out for appointments, very, very high conversion rate. Traffic on websites are extremely strong that the builders are reporting, as well as the brokers. So I think, just anecdotally, one of my associates that lives in Chicago with his new wife is in an apartment building is like, this is going to push us out to the suburbs. We're going to want to buy. So I feel like what on the front line, if we get this economy going, even if we had 20% unemployment, 80% are still employed, and people are going to want to be homeowners. Now, what worries me the most that I've been seeing, and Barry, I've talked to you about this, and my biggest concern is as a result of kind of the chaos and what you're describing as, companies that could wind up going bankrupt or just can't continue to fund mortgages, is the credit overlays that are now being employed. That is the biggest concern, because we had an entry level where the strength was the greatest. I'd say that entry level buyers are predominantly being underwritten with FHA VA. And we looked at the number of borrowers that had a DTI above 50% and a credit score below, call it 660, 680, which, by the way, is the new norm, is that now you have to have a 680 and be below 45 or below, roughly, in the feedback we've gotten from the mortgage originators. That could be anywhere nearly what was the market. 45 to 50% of entry-level borrowers are in that category. So the government is going to completely shut down housing because prospective buyers won't qualify. Recognizing that they might go into early payment default, even builders that have captive mortgage subs may not sell to aggregators and to wholesalers that demand that they have much, much higher credit standards, and underwriting stringency is great. They too have to sell to Fannie Freddie's cash window, or they're selling directly to Ginnie Mae securities through bundling. They too are raising their credit overlays. So that's what's really concerning me. So we have forecasts that we went back and looked at the worst disruptions that this economy has had in terms of the impact to housing going back over 30 years. And we modeled our forecasts, again, using 2Q as our worst case. And those numbers that we actually used in 2Q were pretty much aligned with some of the worst quarters in the Great Recession. And so I think that we recognize that coming out of it, it's still going to be ugly, but what you guys are describing could shut it down completely, where there aren't going to be home sales, even for those people that want to nest, that want to have their own home that they know is clean and taken care of by themselves. So being in apartment buildings is probably where the social behavior might really be quite different going forward, and therefore home ownership would be even more critical. But what you're describing is very disconcerting.
Well, so I'm sorry, David, I wanted to ask Ivy just as a follow-up here. So let's assume that the good people that are on the panel here, and they're all extremely influential. And I want to hear from them just in a minute to get a chance to ask some questions, because they're always going to be great questions. But Ivy, I think the question that everyone that is listening, and we have 4,000 people on a live, which is, that's amazing. Shows you how important this message is. I think what we're all waiting to hear from you, Ivy, is let's assume that the good effort that we're all doing figures a Band-Aid to cross this bridge and get us over it with the mortgage industry relatively intact. What do you see the drawdown over? I know that Q2 is going to be disgusting, but what do you see the drawdown? What can we anticipate in price declines for real estate? And then how long do you think it takes to recover this drawdown? And therefore, for those people listening, for their clients, for their real estate agents, is there an opportunity that they can seize to over the long term have a very good outcome? So can you please add some color with that assumption?
Right. So again, a very important assumption to make, that 2Q's worst case. We looked at where home prices were roughly starting the year and into February. Home prices are running up, call it 5-ish%. So if you think about 2Q being somewhat disastrous, with inventories as tight as they are, which they are at record lowest levels in history post World War II, I think that the number of sellers that are coming off of the market that would have sold, they're going to be somewhat likely to come back on the market. But with inventories continuing to decline, we think there's probably about 300 basis points, 200 to 300 basis points from that high level. So we're forecasting a year-end home price right now at 3%. So really 200 basis points down, which is pretty much what we've seen in other periods of economic disruption. Again, making that very optimistic assumption that we get through this after April to some incremental improvement.
So just to so everybody knows, Ivy, that seems to me like that would be, that'd be a blessing, to only be down a couple of percent. Actually a gain year on year of 3%. I mean, I have a praying that happens, but I just have a fear that we may see some price declines that are deeper than that. So we're all very, very happy to hear this report. Do you have a model that is a bit more bearish that you want to share with us? I know you don't have one. You have kind of
no, right. We have sensitivities around what our expectations are. Certainly on looking at our bear case, which would be more likely in a Great Recession type of downside. I think that the order of magnitude on pricing clearly would be much more significant and not anywhere showing growth. The reason that we still expect growth, and again, assuming again that May 1st is sort of our back to work starting point, is because where inventories are. And I think that affordability, we're assuming that although spreads, have sort of stabilized, call it that 265 basis point range, that we're not going to have massive credit tightening like we're seeing right now. So some of the assumptions that we made last week are now obviously changing. So the outlook for, a few hundred basis points of deceleration becomes much more at risk if we start to see the credit tightening and the mortgage chaos that we're seeing. So a lot of this has changed since the forecast, but I would say it seems optimistic, especially hearing what you guys are indicating, and certainly would think that the, people that need to sell, you're in that distress mode. They say in real estate, the 3 Ds, death, divorce, and default. You would likely see people that need to sell. But I think that where inventories are, that gives us some protection that we will not see the type of declines that we saw in the Great Recession. But clearly home prices would probably be under pressure. Anecdotally, we're hearing, some pressure year over year in that 1 to 3% right now.
That's really not that bad. And Ryan and Frank and Andrew, please chime in. You guys have been so gracious and patient, but please chime in with your thoughts and questions.
Can I chime in real quick? Because the call
Ryan.
is so good, and David's highlighting the challenge, Ivy's highlighting the opportunity and the solution, and she's right. If we could open up the gates and remove some of the overlays, that would help the opportunity to go back and purchase some of these houses. I'm kind of the guy on the street on this call, and I'm telling you, and the originators, I hope you understand now why some of these lenders are having to implement overlays. even with these overlays, there's still risk, guys. So we are closing loans, and this isn't even Main Street because this is a 24-hour-old story. Some of these are 2 or 3 days old. Even with 620 and 640 overlays, and even with 50% DTIs, even altering our lock policies, we're closing loans, and 2 days later that fit in this small box, we're getting calls for forbearance. And what worries me is it's not the hairdresser. It's also the guy that has a construction company that was a $700,000 loan with $200,000 in the bank. They're so upset, and I get it. They're so upset that the way of getting back that their business has been taken away is, I'm not going to pay my mortgage. And that only compounds the problem that David talked about earlier. So even with the overlays that I know that originators are so upset about, we still have risk, and we're still accepting that risk, and we're still writing loans in a really small box, and we still have risk on top of that. So I hope that makes sense to the originators that are watching why there's been some overlays. But I hope you also understand that there's still risk for the lenders that are still out there lending money. I hope that makes sense to everybody.
It does, Ron. I just want to explain, because I believe that this call will be seen by many more people than just originators. When we talk overlays, you go ahead and explain that so people understand, get that.
So yeah, lenders are trying to limit their risk in a crazy time right now. And so they may have done loans maybe just a week or two ago down to 580 or below. And so you have to try to— credit
score would have been down at a credit score that would be pretty forgiving.
Correct. Or maybe your debt to income ratio, we closed loans just 2 weeks ago at 50 or 55%. That was allowable. And so lenders are trying to figure out kind of the sweet spot of, hey, how do we limit our risk? We have all the challenges that David highlighted already, but we want to keep the doors open. We want to keep lending money. So how do we figure out how to limit our risk exposure? And so they're trying to find kind of that sweet spot to limit some of the higher debt to income ratio loans, some of the low credit scores. But even doing that, we're still closing loans that fit in that tiny little box, and they're going into forbearance, or at least asking about it sometimes the day after closing. I mean, this is happening right now.
It's a terrible situation. Frank,
can I just jump in for 1 second before Frank? With respect to forbearance, I recognize that this is going to create significant problems in the mortgage sector. Isn't it fair to say that those people that are being, provided forbearance don't have to sell? So as opposed to maybe, Dave, to your experience back in the, during the Obama administration, when we were in the Great Recession and during the crisis, foreclosures really were what resulted in plummeting home prices. And if people are just allowed to not pay their mortgage, and then assumingly they get back on their feet and they start paying again, just to think it through, trying to show some optimism, even though the plumbing and mechanics could create massive risk, if people are not forced to sell in a distressed situation, that could mitigate the impact on home prices.
Yeah, I mean, first of all, your V-shaped recovery here is similar. It's exactly what Mark Zandi's predicting, Mike Fratt and Tony. I mean, you're all in the same place. So it's great to hear you say that. And
we're still thinking, though, it's not a V shape from our perspective. Because
not a full V.
We're down 30, 25%, 3Q, 4Q, and year-over-year declines in orders for builders. This magnitude, but so it's climbing out of a dark, ugly, complete halt is what I think.
Yeah. But yeah, on the forbearance side, that's a good, that's the point. My view is if we can solve the liquidity challenge here, you'll have borrowers who reperform at an extremely high rate for all the reasons Ivy's talking about. They bought great homes. They have low interest rates. Economy's fundamentals are going to return on a steady path. And but the challenge here is how many people take forbearance, and will there be enough liquidity to provide it? If we can solve that problem, that'll go a long way to allowing us to get through this thing.
Frank?
Thanks, Barry. First of all, thank you, everybody, for having me here. I'm just going to ask a couple of quick questions. I'm going to send one to Dave and then one to Ivy. Then I'll hear those answers. And then I have to skedaddle. I'm going to be interviewing Rob Chrisman here in just a few minutes. And he's hard to squeeze in as well. He's very busy doing a lot of interviews right now and things as well. So I don't want to miss that opportunity. So real quick. So David, the liquidity facility, brilliant. That's awesome. I think for a lot of consumers, even for a lot of originators, real estate people out there, all the stuff that we're talking about that's going on with the servicers and and the issues back there, it's a lot of, kind of black magic that happens back there. And And it's, it's like, what's, this all mean? And my question is, because I just haven't heard much on this, and maybe it is out there. Maybe it's part of, all the assistance that's being laid out by the government for servicers, et cetera, for investors. But, when servicers have a problem collecting money from a consumer so that they can pay their investors, right? They're also not collecting property taxes. They're not collecting homeowners insurance. They're not collecting PMI payments. And, that obviously is going to trickle down to other industry, to county level, to, tax levels, locally within our communities. I'm just wondering if that's addressed in what's going on right now, because it kind of feels to me like I haven't heard a lot about that. And I don't know if it's kind of like just being kind of missed or forgotten, and we haven't gotten to that yet. And then for Ivy, I wanted to ask this is, before this all happened, the real estate industry was going through a lot of changes, and a lot of, business was starting to change in the way that it was getting done. Specifically, one of the big ones would be the iBuyer movement that came upon us. And now all of them are pretty much shut down because of this. And so my question to you is do you see them coming back, and what do you kind of think of that model? Because obviously after this, everything's changing. I mean, a lot of things are going to change for employers, for the mortgage industry.
That's such a great question. Such a great question.
Dave, do you want to go first?
Sure, yeah, and I also have to scoot in a minute because I have another one right after this. But to your answer, if you read the HUD requirement, the servicer has to advance both PI to the investor and TI to cover taxes and insurance. And obviously they don't want to find, you got to keep the property insured.
Right.
And so the servicer is not going to let that go. And you've got to make sure you're paying taxes to the appropriate county. So yeah, I mean, it's not a perfect coverage, and that has a lot to do with this liquidity facility. And by the way, just please hear my words. I'm not entirely sure we're going to get one stood up. We have extraordinary resistance from the administration right now. So, that's the best outcome if we can accomplish that by putting enough pressure on. I think the best place to put it, frankly, is on the Trump administration. But that would be the TIs do get paid. HOAs, that's going to be another thing. We went through this last time, as you know, Frank, on HOA defaults and where liens could be placed and those kinds of things, and whether they got priority and there are lawsuits over that. So, I mean, all of this stuff is, we're going to be dealing with some of this bumpiness along the way.
What happens if a servicer can't make it? What happens to those clients and the collection?
So servicing, if a servicer fails, servicing gets placed with a new servicer who's willing to take it on, and that has to be done by Ginnie Mae. They've done it before. I hate to throw out the name Taylor Bean and Whitaker, but we all remember that company. They were the biggest one during the last recession, and that was a $40 billion servicing portfolio, which today doesn't seem all that huge, but it was at the time. And that had to all be placed, and Ginnie placed it. And if they have to place it and at a discount or pay the servicer to take on that work, that's their obligation. That's why they collect that G fee. So in the end of the day, it's their obligation to place the service.
Wouldn't that be so devastating, though, David, that it would just, I mean, you're talking about a nightmare. How do you handle the calls, everything that would come in, and who would want to take on servicing?
Yeah. So let me respond, and then you'll move on, and I may jump off this if that's okay, Barry. But
before you go, I got one question for you.
Oh, okay. All right. So real quick, my answer to you is, yeah, it would be terrible. Unfortunately, I hate to say this. There's anecdotally, I've heard from people in DC that it's been said inside the Treasury Department in recent days, maybe we should let a couple of these guys go. The banks will take up the slack. And shocking for a guy, particularly Mnuchin, who ran One West, the former Indy bank, and comes from this business, for God's sake. So right now it's time just to put pressure on. I'm assuming ultimately in the end of the day, they'll do the right thing because it's the only thing that you can do. There's really not a choice. But, who knows? We got to keep pushing.
Andrew, hit David before he leaves, and then we'll go to Ivy to answer Frank's question.
All right, David, I'll be really quick with you because I know Friday we'll do a deep dive at 4 o'clock. But so here's one of the things that I'm worried about. we remember in 2008, the servicers collapsed just because they couldn't handle the responses. The response went from normal defaults were 1% to double digits. So what does this look like? Actually, are servicers going to be ready for the influx of calls that I know they're already getting slammed with?
Yeah, short answer is we all know that answer. Back then we were getting hit by huge waves against the shore, one after the other, month over month, as people progressively went through the crisis, and servicers were overwhelmed. We created a national servicing standards rule out of the CFPB. There were huge settlements by Department of Justice. Servicers paid a ton of money because they couldn't respond. This is the tidal wave, right? I mean, if everybody calls in April, there's no company staffed, period.
Not
to
if,
handle that
when.
kind of inquiry.
Right.
Yeah.
Ivy, do you want to try to get back to this iBuyer question that Frank had?
Yeah, thanks for the question, Frank. There's no question the iBuyer business was hot, and we had seen iBuyer transactions in some markets like Raleigh and in Atlanta and Phoenix approaching almost 10% of transactions. So providing consumers with liquidity was really part of what their mantra was. And I think that right now, from a health and safety perspective, they really felt that they needed to put their employees first. And that was really the decision, as well as in any case, in thinking about putting more risk on the balance sheet. My view was that many of them couldn't afford to take on all that inventory and risk of not selling it. So it's a combination, I think, and also reputational risk, because I think that they would require a higher fee for those that were trying to sell during these times. So rather than gouge the consumer, I think their decisions were to temporarily suspend. Now, when and if we get back to any type of, call it normalcy, I think there's a few that will come back to the market that have the capital and liquidity to move forward. I don't believe all of them will. And I think that the number of startups that really weren't well funded, that had been doing something of a derivative of an iBuyer type model, providing cash to consumers to buy their dream home and guaranteeing on the back end that they, give them a guaranteed purchase of their home at a price. All of those type of models are probably not going to return. I think that startups today are going to have a very, very tough time that aren't well funded. One thing that I wanted to note about the iBuyer that is definitely a problem for builders is that a lot of them that actually were providing the new home buyer the ability to buy because they were buying their home. They've seen that result in cancellations for them because they're no longer going to provide that consumer the ability to sell. So that's one of the backlog concerns we're seeing. So I don't know if that answers what you needed, Frank.
Absolutely. Yeah, I appreciate it. Thank you very much.
You're welcome.
Question, Barry.
Yes.
And it was for you, you three. David's off the call now. Are we ready to say that the Fed's buying excessive mortgage-backed securities is in our rearview mirror? Is the margin call issue fixed? Can we say that?
Yes, we can say that. We know, and I've gotten confirmation. Peter Bookvar and I were talking this morning. He spoke to Kaplan, and the Fed's heard our message. So our piece that we wrote here, our little company, it got in the hands of people, and the Fed who understands it. I've met Jerome Powell. He's a really, really smart guy, and he gets it. And you can't blame them. But the second they figured this thing out and they saw what we had put together, and thanks in part to everybody here, so collectively we could all say we really did a good thing here for our industry. But now we have another challenge in front of us, as we've discussed. And I know, Megan, you had a question with regards to rates. Am I right?
Yeah, so I was just curious, your guys' thoughts on after all of this. Do you see rates continuing, bye Frank, do you see rates continuing to stay on the lower side? And what is kind of the short/long-term outlook as far as rates are concerned?
Fundamentally, there's every reason to believe that interest rates remain low for a very long time and give us a great opportunity to put people in homes. And Ivy, obviously you have thoughts on this as well. I'd love to hear from you, but there should be a very long period of very low and attractive interest rates. The questions that come up are a short-term demand shock, maybe as we're all caged up and we get released out of our cages and we want to start doing things. If, pray to God that we're healthy and we can do them and that we are working. But maybe the supply side doesn't meet it. So you have a transitory inflationary spike, but there's something else. And Ivy, you and I were talking about this. What happens if after this is all over, there is some friction between maybe our government and the Chinese government? Maybe there's some finger pointing that goes on with how this was handled, and maybe it stresses that relationship. And as we're finding out now with medical equipment and a lot of supplies, you go to Amazon now, and before you could buy something from Amazon, there's a warning that it's coming from China. So do we now find out that all the manufacturing that we're importing to keep costs low causes an inflationary period of time through that adjustment? So there is a possibility that we get some bumps along the way, but I do see a low and attractive interest rate environment. Ivy, I'd love to get your take.
Well, I think that, we're expecting that rates will, stay low just if the economy is in recession, and certainly, looking at the 10-year, and even if we start seeing yields approaching, 1% or higher, and you hold spreads relatively in some normalized range, we'd like to think that we have a 3 handle and nothing even close to 4%. But again, if your inflationary outcome comes to fruition, that would clearly change in terms of what rates might do. But we're more concerned because I remember back in 2010 and 2009, 10, and even 11, rates were at record lows at that time, and yet housing was still in the slump, and that was really due to credit overlays and lack of mortgage availability. So the credit underwriting stringency is even more important than absolute rates when you think about prospective home buyers. And so what we're looking at right now are no question, you and I have talked about it a lot, Barry, housing is likely to be one of the tallest midgets if everything's functioning right. If we have the mortgage market on a solid footing, credit overlays come down some, people want to own homes, and there's such a strong demand and there's such a constraint on inventory. So I do think that housing should be better positioned, but so much depends on the mortgage market and those underwriting stringencies.
So let me ask you a really hard question. And by the way, thank you, Ivy. Those are really great thoughts. And we're coming right up on kind of an hour, so we want to try and be respectful. So we'll just see last thoughts. But Ivy, my last question for you is, so let's put our hat on as an opportunity, because we want to talk about opportunities out there, right? And let's look at housing as an opportunity. So let's just say there is a bit of a drawdown, and over the next quarter to 2 quarters, we come down in pricing. Somebody who purchases a home today, what do you think 5 to 10 years from now the potential appreciation for that would be in your opinion? I know you do these models all the time. What are your thoughts, Ivy?
We don't have models that go out 5 or 10 years. Credibility starts to wane when we talk about 2021. But I think that this country is a great country, and I think that people still believe in the American dream. So if I was buying a home today and thinking that, it's one of the few ways that, consumers can create wealth for themselves, we have to believe that that trend line is going to be on an upward trajectory. Where right now, we have to think about how people will change behavior, and think about all the people that are living urban right now in these dense areas that are going to consider that I don't want to be in an elevator where someone else was pushing the button that might be sick. I don't want to be in crowded areas. I think suburban living, rural living is going to have a massive comeback. And I think that's great for the housing market. It's great for the builders. And you're going to see that people want to be in their homes. They want bigger homes. Imagine being in an apartment right now in the city. It's hard enough being in a small house, but imagine being in an apartment.
It's causing divorce rates to go up, I'll tell you that.
Well, the birth rate is probably going to skyrocket. We hope, right? They don't kill each other. But it's really, from our perspective, it's going to be what had been, people want to walk to work, they want to live urban, they're going to want to move to the suburbs, they're going to want to have their own homes, and there's a shortage. So we talk about home price outlook. It to me, trying to be an optimist, and I'm a worrier, Barry, you know that, I'm worried about everything. I really believe that housing will be the tallest midget coming out of this crazy pandemic nightmare we're living through.
Well, everyone, I'd like to just see if there are any last closing thoughts, but I just want to say that Ivy, I just adore you. I think you're amazing, and you are just incredibly brilliant. And I want to thank David Stevens, who had to jump because of his time. I think David's just a great leader in our industry, and he's done so many good things for us. He's been a great friend to us here. And also, Frank Garay, who's also such a great leader, he had to jump. But meanwhile, Andrew and Megan and Ryan, thanks for your time. And any closing thoughts from you guys?
I just want to say in the questions box, we got a lot of questions about what loan originators and real estate agents should be doing in this time. And I think from everything that you heard on this call, a big part of it is just educating yourself so that you can have these conversations with your clients, with your referral partners, I think is huge. And then also with social distancing, we need to learn how to shift our business online for a lot of this. So learning how to use platforms like Zoom, learning how to stay top of mind with social media. At least that's my 2 cents on that. I don't know what else you guys want to say regarding
and taking the information that you're learning and sharing it with others that way, whether you're using our social studio platform or some of the scripts, but whatever you do, you can use this. You want to talk about opportunity? This is your opportunity to shine as a leader and be an expert, just like the 4,000 plus people that are listening to this that can educate others. Ryan and Andrew, any closing thoughts?
Go ahead, Andrew.
Yeah, so I mean, Ivy, thank you so much, for joining us today, and Barry, Megan, thank you for putting this together. Really, really appreciate it. And I'm just going to share a couple of anecdotal stories that I'm hearing from both actually originators and actually contractors. Contractors are having conversations with people, talking about things that they want to do with their house. If they're stuck in their house, they're saying, okay, they need new offices. They're spending a lot more time actually at home. We're going to, I'm sure we're going to see a big drop in actually the value of commercial real estate, as we find actually that we're so much more productive working at home in many, many cases. So that's just a little commentary.
Andrew, it's funny you say that because I was talking to one of our major suppliers. So in the housing mosaic of our research focus, I should say, we also do analyze manufacturing and distribution businesses within housing. And the parking lots, at least in this part of the country, which believe it or not was within Oregon and Washington, you had packed home centers where parking lots were packed with people that are doing just what you said. They're home, they're doing projects, and they're nesting. They're fixing things up, but they're also looking at, do I want to put in the new carpet that I've been, not able to have time to do? And so those are positive things that, should enhance people wanting to stay in their homes, not walk away and get back their keys and the things that, we had in the last crisis. But remember, you guys, the darkest day is before the dawn, and we will get through this as a great country. And Barry, you're awesome. And Megan, you guys, great to be on this show. Thank you for having me. But we have to be optimistic, and we have to tell our industry contacts. We have 1,000 roughly industry contacts that we interact with, that we aggregate from boots on the ground. We like to say, we have to believe that we're going to get out of this, and we have to work together. But this administration has got to take steps. And Barry, we need you and those others that can have influence on them to recognize the dire crisis that they're, creating. And so I want to be optimistic, but I also don't want to be naive about what we are facing.
Thank you, Ivy. We're working on it. I promise you that tirelessly. I promise you. Brian, I know you wanted to make a closing thought on your end.
Really just wanted to thank you guys, Ivy. So good. I loved your closing comments and the opportunity that's coming. Hopefully people picked up on that. And Barry, thank you again for putting this together. If Ivy goes live, or you or David Stevens, individually or collectively, I'm telling you, the lenders and the realtors will eat it up. So every day, if you want to go live, and trust me, we will be there listening, because this has been so helpful. Thank you so much for this.
Well, thank you, Ryan. It's in no small part thanks to you and Andrew and Frank and Megan. You are always wonderful in putting this together. And if I may just take us away here, Megan, if that's okay with you, what I'd like to just say to all of you listening is, first of all, a heartfelt thank you. And the people that are doing this, they don't get paid to do this. They want to do this because they have a gigantic heart to take away time from their incredibly busy schedule to help. And that's the great thing. And that's, and that's the spirit that we all have at this time, that it just comes out where people want to do good and want to help. It really is a crisis that brings out the best in all of us. And I want to leave you with a couple of quick thoughts. Back in 1815, there was Nathan Mayer Rothschild, Baron Rothschild, who was about to become the richest man in the world. And what he did is he was buying at the London Stock Exchange, which was the financial capital of the world, at the worst possible time. And he became the richest man in the world. And they asked him how he did it. He said, you buy when there's blood in the streets. And Sir John Templeton, one of my favorites, he said, you want to be a buyer on the most pessimistic day. And then there's Warren Buffett, who said, you want to be greedy when others are fearful. So what I'd like to tell you is that have some faith that you can see beyond what you see in front of you. When you're driving down that dark country road at night and all you see is what the headlights will shine upon, you have to have faith that you can see beyond those headlights. And I want you to have faith that we're going to come out of this and that there's opportunities that you can identify right now. So just be calm, just think about those opportunities and utilize them to do good. So God bless you guys, and thank you for being with us today. We appreciate you.
Thanks,
Thank
guys.
you, everybody.
Thanks, Barry.
Bye.